All right, so in this video, we are going to take a look at some MEC treatment, and we're going to focus on the topic of catch-up contributions. It's an interesting topic, and it is great knowledge to have if I own a whole life insurance policy, or if you are considering one, or if I'm an agent, because it really allows me to make up for lost time. You're going to see that's exactly what it allows one to do, but I can continue to enhance an existing policy, and a lot of times people see this and think, or say, hey, I didn't know I could do that. This is a great tip or great piece of knowledge to have. This way I can continue to maximize an existing life insurance policy, especially if I have more money, and not have to start all over with a new policy and go through the early expenses again. And everyone's situation is different, of course. But let's take a look here. So when it comes to the MEC limit, it is a cumulative number. And really what that means is any unused MEC space will roll over year to year. Kind of like those old cell phone plans with the rollover minutes. Remember how those worked, where I could bank on any unused minutes and they would carry over to the next month and then I could use them? Similar, only with the unused MEC space on a life insurance policy, you will find that that unused MEC space is cumulative, continues to compound on itself. What that allows one to do is make big catch-up payments down the road if their situation permits. And we're going to demonstrate that here as well. So when it comes to the policy design, right, we always talk about when I set up a policy, where can my money go? I can allocate it toward the premium or the PUA rider. Now, when I actually craft that policy, when I design it, the items I have to be aware of as an agent and a policyholder are the limits. Two primary limits I want to be aware of. One is the insurance company limits. Specifically, what I mean when I say that is if I want to pay in $50,000 or any amount of money per year, my money can go toward base premium or PUAs. Wherever I set my base premium, how much will the specific insurance company I am considering allow me to add into PUAs per year? What I will add is all companies have slightly different rules and regulations there. The companies that we prefer, the larger guys, have all right around a 10x limitation. Some are 11x, but it's right around that 10x limit. The example we're going to look at here, the spreadsheet, has a 10x limitation. Specifically, what that means is if I have a $5,000 base premium, the insurance company will allow me to pay a maximum amount of $50,000 per year. 10x my base premium payment. So the first limit, insurance company. Second limit, IRS, MEC limit. That's important here. We want to make sure that our life insurance policy does not become classified as a MEC. Now, because it is a cumulative number, I can bank on unused MEC space as time passes, as we mentioned earlier. To demonstrate, if I have a policy with a $50,000 MEC limit and a $5,000 base premium, so now I can commit to a low number, the base, and have the ability to go up to $50,000. Let's say I do something like this. I pay in $25,000 in the first year. We're going to assume the first 4 years. So what that means is I could have paid in $50,000, but I only paid in $25,000. So that means the additional $25,000 in unused MEC space, we're going to call that, will continue to compound year over year. Meaning, year 2, I can make up for lost time and make that payment. As time passes, I can continue to make up for lost time. So for example, by the time I hit year 4, I have the ability to throw in an additional $100,000 in unused MEC space. That was money I could have paid in during the first 4 years, but I did not. The insurance company will permit me to make a large lump sum PUA catch-up payment to make up for lost time. As a quick side note, the policy does have to be constructed properly for the company to actually take those payments without going through medical underwriting. That's a whole nother conversation, but that is very important. And then second, they will allow us to exceed that 10x limitation when it comes to catch-up payments. We've never had a problem with that. So for example, here, when I first start a policy, $5,000 base premium, ability to go up to $50,000. Okay, great. Year 5, let's say I sell a piece of property and I want to plow $150,000 total into the policy, max out the MEC limit that year, and make up for lost space, I can do it. The company will accept it, provided I don't MEC it out and the policy is constructed properly where underwriting is not required. But 150K obviously exceeds 10x the base premium there because I'm making up for lost time and I could have got the same dollar amount in if I paid in 50 each year. We can make those payments. We've done this several times with several individuals that have had policies. So let's demonstrate this actually. What we're going to look at is a policy on a 40-year-old male paying in $50,000 per year, or I should say carrying a $5,000 base premium and $50,000 initial MEC limit. The example on the left is what the policy looks like if I max fund it from day one. So 50K per year, crossover point, I'm positive by year 5. Okay, looks great, keeps on growing. I have paid a total of $500,000 into the policy on that example. The reason why we are showing this example is whenever I look at catch-up payments or any payment frequency where I bounce payments up and down, what's the impact? Time value of money. How much do I give up? What's the difference in cash values? We have it side by side so we could see it, but that's why I put them side by side. Now, this guy over here with catch-up contributions. So, exact same policy. $5,000 base premium. 20K PUA. I've got a term rider attached to both of them. Annual outlay, $25,000 per year. Break-even point, just about year 6. Here's really what I want to focus on though. Let's put this in green. Years 1 through 4, we paid in $25,000. The MEC limit was $50,000 in this example. So just like that example we had on the whiteboard, the unused MEC space is rolling over year to year. That is how I make a large catch-up payment, a total of $150 into the policy in year 5. Here's another way to kind of break it down. I have a MEC limit of 50K per year. By year 5, what's the total amount I can get into the policy? 50,000 times 5 years is $250,000. How much have I gotten into the policy in this example? 100 over the first 4 years, and then 150 in year 5, 250. Over in this example, by year 5, how much have I gotten into the policy? 250. Exact same dollar amount in, only difference is in this example, I max funded it each year, whereas this guy, I 50% funded it and then made a large lump sum catch-up payment. What's the difference in net cash value though? Because this guy, as I get money into the policy, I see compounding right off the bat on everything. Whereas this guy, not quite. So, I received compounding, but what I've paid in, by year 5, I've got 238. Over here, 252. So I do see a difference, right? Because I've gotten more money into this policy faster. Now, time passes, year 10, make another large catch-up payment of $100,000. We repeated the same pattern, but you'll notice this is not 150. The reason why really has to do with the MEC treatment. So without getting into too much detail here, after the 7th year, if you've seen any of our other content on MEC laws, you may have heard me say this before, after the 7th year, typically what happens with our MEC limit on any life insurance policy? Resets, and it's based off of our age and death benefit from that point forward. Whatever it is, when I start a policy, it is set in stone for the first 7 years, unless I decrease the death benefit, I can adjust it. But for the most part, it's set in stone, and then at year 8, it will reset, again, based off of my age and death benefit. So, it did decrease in this example. We could not make another payment of $150. We did not want to MEC it out in the example, so we paid in $100, but I wanted to make sure we paid in the same dollar amount in this example to this example. So we made 2 more payments of $25K. Point being here, year 12, paid in a total of $500,000. I have 604. Over here, by year 12, paid in 500, but got it in 10 years instead of 12. By the 12th year, I've got 637. So there is a difference in this example, and as time passes, you'll see this guy continuously have more in cash value, and that's really just time value of money. I got more money into the policy faster, it's compounding right away, puts me a little bit further ahead. With that said, having the ability, or I should say awareness to do this, gives me a nice edge. Because let's say I build a policy out where I want the ability to pay in $50,000 per year, but again, I don't want to commit to it. And I might have some windfalls down the road, say it's 150, 100, and we could stretch this out longer as well. What's the worst year of any life insurance policy? Early years. Best year, every year after the first and second year. Point being is if I can make large lump sum PUA payments to an existing policy that is already over the initial insurance expenses, if I anticipate being able to add more money into a policy or windfalls and I deliberately build out more MEC space to accomplish that, good to know, as opposed to just max funding a policy and then when I come into more money, opening a new one. And again, it's always good to weigh out the options there. We like to do that kind of stuff. However, if I can bank on some MEC rollover space, doesn't hurt me. So, know this one was a little bit deeper than most. Hope it was helpful. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.